Hey everyone, it's Caleb Guilliams here, the author of The And Asset. I am here in Arizona in the Life 180 studio with my good friend Chris Kirkpatrick.
Hey guys.
And what we're gonna do is we're gonna break down a common question. It's IUL versus whole life. I wrote a book on a strategy on how you can overfund whole life, use it as the best place to save your money, have that money grow the rest of your life, be able to utilize it to buy the things, invest in the things that you care about, have it show up powerfully in retirement, protect the most important asset, which is yourself. Yeah. And what I found is a lot of people are actually using my book to promote their product, and a lot of it is Index Universal Life. It's definitely the most popular thing being sold on the market right now. Yeah. And there's a lot of things that you need to know about this. I will openly say I don't want you using this strategy, using IUL, and the hope is that we can just have a conversation as it relates to how that works, the difference. And the reason why Chris is here is, and you can kind of share your story.
Sure, yeah, absolutely.
But you used to sell a lot of this, and you recruit for Index Universal Life, and I think we need to be fair. It's not for us to just say it's all bad, it's all garbage, would be very ignorant.
Yeah,
and I already know that this video is going to get a lot of hateful comments.
Yep.
And so I want to be open-minded as well, but I also want us to take a step back and really think through not just what the illustrations look like, but like what is actually going to happen in 20 years.
Yeah, I mean, you just hit the nail on the head. So for everybody who doesn't know my background, I used to be licensed. I used to sell insurance. I was the head of recruiting and development for a Fortune 1000 life insurance company, broker-dealer. Their focus was IUL. They were one of the top IUL manufacturers, producers, sellers in the world, in the country, I guess, because we're pretty much the only country that really focuses on these. So we could say the world. But the bottom line, with this is there's a lot of people out there that are selling this as an investment. And I want to say right out of the gate, that's just thinking about it wrong. If you've watched any of our content, if you ever think you're going to buy an insurance product to be like a pure investment, and that's how you're buying it, or you're buying it for that purpose, I would say you're going about it the wrong way. And if any insurance agent is trying to sell you that this should be an investment, then I would look to talk to somebody else, because they don't understand all the moving parts to this. So there's a couple things here. So what I'm passionate about, while I used to go around and I used to sell this before I understood what I understood, and when I used to recruit people and train people and teach people how to structure IULs to be, kind of across the map, all the different structures that you can do, and they are very flexible. You can do a lot of crazy things. And what I would say is this: what I love, if you've watched our How to Structure a Whole Life Policy, we got a couple different versions out there now. You look at the illustration and you see the guaranteed column and you see the non-guaranteed column, and they're pretty close. But the difference with a whole life policy, when you look at the non-guaranteed column, I could make an argument that the non-guaranteed column is going to actually be less than actually performs in the future. It may not be, but there could be arguments made either way. The good news is that the guaranteed column, you could get that contract, you could get a whole life policy utilizing the guaranteed column, and you're never going to be hurt, right? Like you're going to be in a better situation. And so for me, one of the things that made my shift in my life away from being an IUL advocate and turning into a whole life advocate was, I never want to have to look at my clients in the eyes 10 years from now, or when they're hitting retirement, and feel like I got them into a product that actually had any chance of hurting them. Yeah,
and this is what I would say. Two things. Number one is when I was running the bank's investment department, I actually helped bail out another agency, and guess what? Everyone was being sold these UL policies, and they were all getting letters in the mail saying, if you don't put X amount of money, you're gonna lose your, they saw it as their retirement account, but like they're gonna lose their whole thing.
Well, let's talk about why.
But then the second thing is, I get sick and tired of people saying, oh, I do whole life and universal life, and for those people that are super conservative, that don't want to lose anything, I put their money in whole life, and everyone else who has a little bit of risk tolerance. Chris, you and I have pretty high risk tolerance.
I have maybe the highest risk tolerance of anybody I know.
I have a company, we work with people all around the country. I'm investing in things. We're putting hundreds of thousands of dollars in marketing. I have a pretty high risk tolerance. If someone tells you that, they have no clue what
They
they're
don't
talking
understand what
about
they're doing.
because they're seeing life insurance as the end result.
Yep.
And you will lose if you think of a product is going to help you long term, and that's going to be the end thing. So sorry.
No, dude, you just hit the nail on the head. Well, I think it's key to understand. So, going back to the ultimate flexibility, you can design an IUL to look similar to a whole life policy.
Right.
But the thing, when you can take a whole life illustration to the bank, you can never trust an IUL illustration. And I will say, you can make an IUL illustration look like almost anything you want it to look like, right?
Yeah, amazing.
And they can be conservative. Like, I could tell you one of the practices with the company that I was with, the people would go in and be like, okay, let's be really conservative. Let's just, let's illustrate this thing at 6%.
Yeah.
And that's their idea of conservative, is 6%. And so that doesn't account for the fees and everything that goes into the IUL contract. Now, the part about this that's crazy is when you get a whole life contract with a mutually held whole life company, I should add, those guarantees are ironclad. You are like a stockholder in that mutual company. You're part of it. That's what that contract is. Mm-hmm. With an IUL, unlike with a whole life, the insurance company takes the risk. They're offsetting that risk to you, to the policy holder. So if you look really close at the details, the fees or the return of 6%, if that's what you're illustrating it at, and they'll tell you, well, the average rate of return over the past 80 years or 30 years or whatever it is over 8%. So I'm going to be really conservative and I'm going to show you 6%. Some of them go crazy and go like 5.5%, but that still doesn't tell the whole story, because the fees, if you really look at the fine print, they're not guaranteed. The fees are never guaranteed in those. There always is an option. First of all, with an IUL, every single year you're getting like yearly renewable term. That's what you're doing. So every single year your cost of insurance goes up, period. And so
they go up, but they can even go even higher because.
Well, the cost of insurance goes up, but then there are internal administration fees that they never tell you about, that they have complete ability to jack up the rates on those for you. Like, there's so many, the bottom line is we don't have enough time to get into all the moving parts.
But let's go back to the philosophy.
Yeah.
You said this, but I want to highlight it again. Whole life, and we have a lot of videos. There's a lot of whole life that's not being sold, right? So I'm not making a blanket statement here.
Sure.
But whole life, the insurance company keeps the risk.
Yes.
Okay. The insurance company that is like in the business of risk management.
Sure.
Index universal life or universal life is what they're saying is they're shifting the risk over to you, and that is the big difference. Yes, there's levers and fees that on the UL that can go up, and yes, the index may not average. That's not even the big point. Long term, it's life insurance is not an investment. It's a place to store capital. It's a place to protect your money. It's a place to. There's a lot of other. It's the ultimate and asset. And on one side, you can have a company that's been in business over 100 years, managing that risk, taking key things off the table for you, or you could roll the dice and put your money in something that's not an investment, but at this point, you could just call it an investment. For sure.
And so with IULs, I'll say this is. Another thing that agents do, and what you just said kind of like sparked this in my brain, is they'll say, okay, the whole concept is it's you get a range, and I don't know exactly at this very moment what companies are doing, but it's usually you have a floor of 0, so they sell you on the fact that you can never lose money. If the market goes down, it's in an indexed fund, so if the market goes negative 20%, you're capped at 0. On the upside, maybe the market does 25%, but you're going to be capped at 12 or 13% or whatever that would be. So the pitch is like, would you be okay guaranteeing that you're never going to have a negative year? You're not going to have those massive 25-30% years, but is that worth it to you if you can get maybe an average of 8 and never have a negative year? That's the pitch, right?
Right, and it's valid. If we just look at the index, it's a valid argument.
Absolutely. But that doesn't look at the fees. The thing is, a 0 year for you, if you buy that policy, is not 0, because there are still fees.
Exactly.
And if you have multiple 0 years in a row, which quite frankly, if you have a policy for 30, 40 years, you're going to have that happen from time to time, maybe a couple times during your policy. If you have a couple 0 years in a row, they have the ability to up the fees, up the administration costs. Like those fees will eat into your insurance costs. All the while, every year your insurance costs are going up. So that compounds the loss. So it's really not a zero-sum kind of
100%.
situation. And it's really the idea that you never want to interrupt compounding. There is zero capability for an IUL to guarantee that you will never interrupt compounding, even though they sell you on the fact that it will.
Another big issue that I see with IUL is, number one, a lot of people are selling it as a banking strat. Like you can do this, my strategy or the strategy that we teach with IUL. And by the way, if anyone's sharing with you that you can bank with it, there's added risk there, because now you're usually dealing with a loan arbitrage, and it's really kind of shady stuff. And even Nelson Nash, the founder of the infinite banking concept, was very anti-universal life for that reason. So then if you take a step back and say, okay, I'm going to do universal life as an investment alternative, then like how do these things perform in retirement? Because let's just say you have $1 million. Let's just say you have $1 million of cash value. How are we illustrating that in retirement, and what are the risks that you could face when you hit retirement?
I mean, the risks are huge. I mean, when you talk about so there's this whole idea of like order of returns, right? That are important. And when you retire, if the market goes negative and if you're using an IUL as an income-based strategy, which is quite frankly why everybody buys them. It's how everybody's selling them, is based on income, tax-free income at retirement. There's all sorts of content out there on that, and I would just caution you against that. But what happens is, and I've seen it, trust me, I've seen this so many times.
You were in the business.
It's mind-blowing. Like it's astounding to me that it's even legal to sell it in this way, because so many problems happen from it. And so let's just say you had $1 million in cash, you know, in accessible cash in a policy, and you're 65 and you're looking to retire, and you want to use that. They're going to be able to illustrate out of that, and my numbers are going to be probably off, but the ballpark be close enough for a conversation. You might be able to pull out $60,000 a year, $80,000 a year, which according to Monte Carlo simulations seems really good, because if you look at all Monte Carlo methodologies out there, they're looking, you know, if they say 4% distribution on $1 million, that's pretty conservative long-term gain. So to be able to illustrate 6 to 8%, sound, once again, on paper, looks pretty amazing.
Tax-free.
Right?
Yeah,
tax-free, looks pretty amazing. But the problem is, you do that, you take that money out, and now the market goes down. Or like if you retire in 2008, you know, what happens if that's you? And then you're 65, the costs of insurance at that point in time are super high, right? And so I've seen policies when people get into retirement that look really healthy, and then 4 years later look like a complete nightmare. You know? And so once again, it just comes back to the fact that it's just a dangerous game. You know, and the reason it's dangerous is because IULs are so flexible, and you can make the illustrations look like virtually whatever you want, because there are so many moving parts. And that's why I like the simplicity of a whole life policy, because you know, I'm a big believer in you should never invest in anything you don't understand, right? And you know, just like I don't think most people understand all the moving parts of most mutual funds that they're invested in. You know, most people shouldn't buy individual stocks because they really don't understand the companies that they're buying. I think it's so easy to understand a whole life policy, and once again, you're not really investing in it. You're just storing your money. You know, like, so I guess to kind of sum this up, unless you have anything else,
and this is what I think. In all fairness, there are people watching this that are in the business of doing universal life, and I want to challenge you to take a step back and say, it's not just in theory, but what's actually going to happen, and like how are people actually going to use this? That's number one. And I also want to say, I have seen people in the space doing special universal life with high net worth people that they understand the risk, and it's going to serve them in some way. I'm just saying, across the board, most people are being sold a bill of goods that, number one, that they don't understand. Number two, it's not going to give them the result that they actually want. Number three, they're taking on a lot more risk than they should, especially when there's better alternatives out there. So that's my summary. I want to be fair, and I also know that what YouTube can get really into a dark hole is people going back and forth, and I in no way want to say things or throw a punch at someone and so hopefully that this doesn't offend someone that's dedicated their life to helping people, but I really want us to take a step back and really think through what we're actually doing, because even in the business that we're in, there are practices that if I really take a step back and say, would I put my grandmother in this? Would I put my mom in this? It helps you figure out what you should really be doing.
Well, and I can double that up and say that, listen, with the company that I worked with, there were so many good people that were selling it, but with agents, I think it's key to understand this, and if you're an agent watching this, I would really encourage you to step outside the box that you're in, especially if you work with a company like I work with, or like a captive company, or you have a captive relationship, or you're really committed to hitting a leaderboard with a company or something of that nature. The training that you get is very one-sided, right? So like the information that you're taking in is going to be directed to achieve an agenda for that company that's trying to get you to sell their product, you know? And that's exactly how it was for me for the first year and a half of my career. I was all about that. And it took me meeting with Don Blanton, quite frankly, you know, that changed everything for me. So that's it. I mean, you know, once again, don't mean to offend anybody, but at the same time, you know, truth is truth, you know, like, and if you disagree with anything I say, put it in the comments, you know, like, and we can have a conversation about it. But anyway, I hope this serves you. I hope it helps. I hope it makes sense. If you have questions, definitely feel free to type them out in the comments below. And also, if you're somebody who's looking for help, or if you're an agent, you know, Caleb wants to give you a free copy of this thing, right? And,
read it.
And I know it'll change your life. I know it'll help you. So definitely go to the link below. If you're an agent, there's a special link for you. If you're somebody who's looking for help for your personal finances, there's a special link for you. Go check it out. And until next video, live abundantly, live efficiently, live life 180, and have fun.